let's talk about investing. For a lot of people, just hearing that word brings up a knot in their stomach. You're worried to lose money, or maybe you're just totally overwhelmed by all the noise. Well, you are not alone. Today, we're going to break down a simple, rules-based investment strategy that's designed to take all of that fear and just push it right out of the picture. I mean, it's a totally normal fear, right? We all watched the markets take a dive in 2020, and again in 2022 and early 2025. It triggers something called loss aversion. Basically, our brains are wired so that the pain of losing money feels twice as bad as the joy of making it. And that feeling, it keeps so many of us on the sidelines, just frozen, wondering if today's the day it all comes crashing down. But here's the thing. While we're all staring at the obvious risk, the market going down, there's this other hidden risk that's way more of a sure thing. It's the quiet danger of just holding cash. It feels safe, doesn't it? It feels like the smart, cautious move. But in reality, it's a guaranteed way to lose your purchasing power year after year.
So holding cash isn't really avoiding risk. You're just choosing a different kind of loss, one that's slower, but one that's absolutely guaranteed. Let's make this real. With totally normal inflation, say 3 or 4%, that $1,000 you have tucked away today, in 5 years, it'll only buy you what about $850 buys you now. That's a 15% loss of your money's power, and you never even made a single investment.
Okay, so what's the answer here? How do you get the growth of the market without that emotional roller coaster? Well, you use a simple, repeatable plan. One that doesn't care about hype or guesswork or staring at charts all day. It's called the CALM strategy.
The strategy is called CALM, and the acronym really says it all. It stands for consistent, automated, low risk, and measured. Every single one of those words is a pillar of a system that's designed to put your investing on autopilot so you can, get on with your life.
So how does this actually work? The entire strategy is built on just 3 simple principles. And when I say simple, I mean simple. You absolutely do not need a finance degree to get this and put it into action.
All right, here they are. First, you only invest in what we'll call sleep-well assets. Second, you use a really powerful technique called dollar-cost averaging. And third, and this is the real game changer, you automate your safety net. Let's dig into each of these. So principle number 1 is all about keeping it simple and stable. Sleep-well assets are just those huge, profitable companies you already know. We're talking giants like Microsoft or Coca-Cola. A really great way to invest in them is through an S&P 500 ETF like VOO or SPY. An ETF is basically a basket that holds tiny pieces of a bunch of different companies, in this case, the 500 biggest ones in the US. It's like instant diversification. And here's a good rule of thumb. If you use their product every week, you probably have a pretty good feel for their business.
Second up is dollar-cost averaging. It sounds kind of fancy, but it's incredibly simple. All you do is invest the exact same amount of money on the exact same day every single month, no matter what. This little bit of consistency turns market drops, which are usually scary, into a huge advantage. Think about it. If you invest $100 when a stock is at $10, you get 10 shares. But if it drops to $5 next month, your same $100 now gets you 20 shares. You're automatically buying more when prices are low, which brings down your average cost over time.
And principle 3, this is where you truly take your emotions out of the driver's seat. This is how you beat that urge to panic sell or get too greedy. For every single investment you make, you set 2 automated rules on day 1. A stop loss that automatically sells if the price drops by 5%, which protects you from huge losses, and a take profit that sells half of your position after it goes up 30%, making sure you actually lock in some of those gains. The rules make the decisions, not your fear.
Okay, so those are the principles. Buy great stuff, buy it consistently, and set your exit rules ahead of time. It sounds good in theory, but what does it actually look like in the real world? Let's check out the math and then see how it played out for a real person. This right here, this is probably the most important number in the entire strategy. Because of that automated stop loss, the absolute most you can ever lose on any one investment is 5%. That's it. It's a hard floor, it's a safety net that protects your money from big mistakes or those crazy market panics.
And this is where it gets really powerful. Check out what happens when you combine that rule with a little bit of diversification. Let's say you spread your money across 10 different investments. If one of them has a bad run and hits that 5% stop loss, what's the actual damage to your total portfolio? Just half of 1%. The risk is tiny and contained, while your upside on the other 9 investments is basically unlimited.
Abstract numbers are one thing, but let's make this totally tangible. I want you to meet Sarah. She's a 31-year-old teacher from Toronto. And her story shows exactly how this strategy can work for a regular person who doesn't have a ton of time or a ton of money to invest.
So Sarah started back in January 2024. She invested just $300 a month into 6 of these sleep well type positions. And over the year, the system just did its job in the background. One of her investments hit a rough patch, and that 5% stop loss triggered automatically, selling it and capping the damage. But 3 of her other ones did great, hitting that 30% gain target, which automatically sold half to lock in those profits.
So what was the final score? After just 1 year of this consistent, automated investing, her total investment of $3,600 had grown to over $4,700. That's a 31% return. And she did it just by following the rules and not stressing about what the news was saying every day. No panic, no greed, just a process.
And that really brings us to the core idea here. Because the calm strategy, it's not just a bunch of rules. It's actually a completely different way of thinking about the act of investing itself.
It really comes down to this distinction between noise and signal. Most people get completely caught up in the noise, the complicated charts, the day-to-day predictions, the impossible game of trying to time the market perfectly. That's a full-time job for professional traders. For the rest of us, success comes from focusing on the signal, just owning small pieces of great businesses, being disciplined, and letting time do all the heavy lifting.
I think this quote just nails it. The goal isn't to be some kind of fearless, emotionless investing robot. That's impossible. The goal is to have a plan that's so simple and so good that your fear, your greed, your anxiety, they just don't get a vote. The rules do.
So the huge takeaway here is that you don't need a crystal ball. You don't have to know what the market's going to do next month or even next year. You just need a process that protects you when things go down and lets you win when things go up, all without letting your emotions hijack your financial future. So where does that leave us? You've heard this saying a million times, right? The best time to start investing was 5 years ago. And yeah, that's true, but it's also completely useless advice. The only time that actually matters now is the second best time, and that, of course, is today.